All right, good Thursday afternoon, Finom Group investors and traders, our YouTube audience. Welcome to Options Expiration Week. January, typically not the best, although each of the last or previous 4 years, the S&P 500 has managed to gain in the options expiration week for January. Does not appear as though that is going to fashion itself here this week, as we are already down pretty sharply on the week, trying to make a rebound here on the day, as you can see. But we've been under some pretty good pressure over the last hour and a half. We had much stronger gains than what you see here out of the S&P 500, Dow, and Nasdaq. So it remains to be seen, whether or not we are going to hold on to some of these gains by the 4 o'clock closing bell. With that being said, it should also be recognized we are seeing a shift in investor behavior, whereby rallies are meant to be sold. That's not what we saw last year, is it? Last year we saw every dip find legs and achieve a new all-time high. Quite the opposite picture here this year. The markets are always sending investors a message. It's up to us whether or not we are able to and willing to absorb that message. New year, possibly a new regime, where we're not going to have 70 plus new all-time highs in the year and seemingly a new all-time high every week. We, as mentioned in the past, this is a midterm year. It's year 2 of a presidential cycle. We're coming off 3 straight back to back double-digit return years. The biggest decline last year for the S&P 500 was roughly 5%. We have not had a 10% correction in now 440 plus days. With each passing day, it actually increases the probability of having a larger correction. We've almost declined 6% here since the all-time high and down a good 3% year to date. It's a dynamic year. We're coming, where we're coming from is unprecedented, and probably where we're heading is unprecedented. But with that said, if you're worried about the price action that you've seen year to date, the good news is there's nothing you can do about it. You don't control, millions of other investors. If that's a problem for you and you think there's something you can do about it, you might be barking up the wrong tree. But here's the main point, and it's pretty much solidified in this graphic if you follow my cursor. Have a problem? No? Then don't worry about it. Have a problem? Yes? Then the next question is, can you do something about it? If the answer is no, stop worrying about it. Guess what? If the answer is yes, then why are you worried if you can do something about it? Far too many investors worry about things that are out of their control. A lot of this year may just simply set up 2023, folks. Maybe that is a little bit of price action sentiment bleeding into a longer term outlook, but do keep that in mind going forward. Nonetheless, buying on red days is where long-term profits begin, and we've had a lot of red days to kick off the new year. 90% of investors and traders are dedicated to finding problems in markets that go higher 75% of the time. The market is only down 1 out of every 4 years, folks. Don't get caught in the problem-finding game, or your psychology won't let you see anything but problems. You'll always be playing catch-up. Build resources, not roadblocks to your capital gains. Again, is there anything that you can do about the problems of the market, the problems in the broader economy? The answer is probably no. Stop worrying about it. Easiest thing to do is to utilize that cash on the sidelines, broaden your time horizons. All right, so we talked about all of these studies that we've seen in the past. January's not shaping up well. The toy barometer just ended, right? That's the turn of year. TOY, Toy Barometer by Wayne Whaley. It helps to inform of the most probable 12-month forward returns for the S&P 500. The Toy Barometer starts in November 19th and it ends January 19th of the new year. Well, unfortunately, we were down a couple percent from that start date on November 19th last year till yesterday, which ended. So we fired a bearish toy barometer. We'll look at that a little bit later. But for now, January, right? You've heard the saying, as January goes, so goes the year. That really hasn't been the case for the most part since 2003. Down Januaries, the final 11 months of the year, have generally been good. You know, up almost 90% of the years since 2003. Remember what we also talked about when we looked at the dates here and we looked at the trend, right? If we started in 08, 09, 010, we had 3 down years in a row. Then what happened? We had 3 up years in a row. 11's not on here, 2012's not on here, and 2013's not on here. Why? Because we had positive January returns. What happened after 3 up years in a row? 14, 15, 16, 3 down years in a row. What happened after 3 down years in a row? 2017's not on here, 18's not on here, 19's not on here. Why? Those were up years for January. So we had 3 up years in a row. 3, 3, 3, 3. But then 2020, down. 2021, down. Here we are, 2022. This pattern, for whatever reason, is playing out once again here, true to form. 3 down years in a row, followed by 3 up years, followed by 3 down years, followed by 3 up years, followed by potentially 3 down years. But again, as January goes, that hasn't been the case for quite a while now. So we'll keep that positive, sentiment here related to the more recent January barometer statistics. All right, here's this one. We came out of a big Q4, right? Remember this? We had a better than 10% gain. Usually the next quarter, 88% of the time it's positive. Big study. I mean, we've got a number of occurrences here, and the average return is 5%. There's been a couple of bad quarters, though. Nothing's 100%, unfortunately, with this study. We talked about so we got the toy barometer out of the way, right? Unfortunately, it fired bearish. And that usually doesn't bode well for the forward 12-month returns. So what we have left here for the first quarter is trying not to get down to the December low. This is the December low indicator, meaning that if you don't go back to the December low the prior year during the first quarter, it usually bodes well for the full year return, as you can see here. 94% of the time, if you did not go back to the December low, the market was positive for that full calendar year. And the average return is pretty nice at 18%, the median return 17%. So the December low comes in at 45.13, folks. We almost hit that yesterday. We closed at 45.30, below the 50-day moving average, but above the 200-day moving average for the S&P 500. Keep that number on your radar. If somebody was to ask me, Seth, do you think that we're going to hit it? It's hard to say no at this point. Like, we see what's happening with every rally. We see that there's concerns and uncertainty out there with respect to inflation, with respect to Omicron, with respect to the labor market, with respect to, of course, the elephant in the room, which is monetary policy, Fed tightening. So gun to head, I'd say I'm cautiously optimistic, but doesn't look good. It looks more probable that we're gonna get down to that level here. But we'll see. Be cautiously optimistic. So as I said before, we looked at the January barometer, and we did not fire a bullish toy barometer. We fired a bearish one. That's not usually good for full year returns, but also, and this goes back to 1950. This goes back to 1950. This study here, see, this one up here is just since 2003. We go further back in time, a bigger study, right? If January was down, the average full year return or final 11 months of the year was only 1.7%. The percent of time the market was higher, 60%. It's not terrible, but again, midterm year. January's off to a rough start. First quarter's off to a rough start. Have reasonable expectations, folks. Have reasonable expectations. Human behavior tends to repeat to one degree or another. And January's not over. I get that. We're heading into the heart of earnings season, right? Next week we're going to get Fan Mag. It's either going to get a lot worse or we're going to find a base, with those mega cap names reporting next week. All right, so talked about worrying. If there's nothing you can do about it, folks, don't waste your time. Focus on your game plan. Unfortunately, this quote right here, unfortunately, this is how most investors perceive investing in financial markets. This is a quote from, I don't want to mess up the gentleman's name, Michael Day, I don't want to do it. All right, anyways, his quote is, "My life has been filled with terrible misfortune, most of which has never happened." Right? I mean, that's what most investors do. They worry, they worry, they worry. They create, these unfortunate scenarios that never actually materialize. They never happen. Right? You're bringing all this negativity and pessimism to the financial markets, to your investing and trading regimen. And yet, most of these unfortunate things that you conjure up and are so cautious and managing risk for never actually materialize in the market. And you believe that by worrying about them, you reduce the risk of harm to your portfolio. You seek reassurance to gain more confidence. You demand more information. You wait indefinitely to take any action whatsoever. You feel you need to know for sure. There's no guarantees with investing, folks. You feel you need to know for sure. If you don't know it for sure, then you conclude it's going to turn out badly. Folks, the market goes from the left-hand bottom corner to the right upper corner over time. That's your premise. That is your bedrock for investing. The markets, one way or another, they will go higher over time. Worry about the things you can control, such as picking good stocks. And if you don't trust your judgment when it comes to picking good stocks, go with the index ETFs. You know why? You can't do any worse and you can't do any better than them by going that way. Uncertainty is equated with threat, right? We feel like if we don't have certainty, then there's a threat, there's a risk. We lack control. We can make mistakes without certainty. And of course, regretful mistakes. There's this study, and I put the link in here, that proves some 85% of the things we worry about never happen. With the 15% that did happen, 79% of the subjects within this study discovered either they could handle the difficulty better than expected, or the difficulty actually taught them a lesson worth learning? To me, that sounds just like 2020, right? I mean, market was down 35%. It's up 120% since then. The pain you felt then was momentary. How are you today? How do you feel today? How have you felt over the prior 12-month period? Don't let moments in time, manifest themselves in such worry that it overwhelms your ability to take action. Worry about the things you control, that you can control. Don't worry about the things you can't. The market's going to be volatile. You can't control that. You can control where you buy dips, what stocks are better value, and how long you want to hold on to them. You can control that. You can't control what's going to happen tomorrow. You can't control the outcome of the election in November. You can't control what the Fed's going to do. Work on the things you can control. Let the other stuff fade away and just give yourself more time. Investing doesn't have to be as difficult as all of the nuances that are discussed on a daily basis in the financial media. And don't buy crap. Heads up, folks, did we not just get another example of that today, right? Don't buy crap. I said this in January to kick off the new year. Beyond Meat, Peloton, Weight Watchers. Don't buy crap. We're in the mid-cycle. How many times have I said that? And what just happened today, the headlines on Peloton, the stock down 20% because they're going to halt production of their equipment, their bikes and their treadmills. Why? Because the demand has faded. Don't buy crap. IPOs, stay away from these, folks. Have you seen the IPO ETF basket? It's a disaster. SPACs, disaster. Some of these stocks are down 50, 60, 70, 80%. Stay away from this stuff. Unprofitable tech. Stay away from this stuff. The SPACs. Here's something from LPL Financial. Because I've said stay away from small caps. What's the worst performer year to date? Small caps. Whereas I say small craps. We're in a mid-cycle bull market phase, folks. These stocks are not going to work the way that they did in the early innings of a bull market. I sound like a broken record. That's why I brought this quote from LPL Financial. Sometimes it's, well, Seth says this, but he can be wrong. Yeah, okay, I get that. Let's hear from a third party. LPL Financial says, while small caps have historically performed well in inflationary environments, this cycle is unique, and we believe larger companies are better positioned for the current environment of supply chain challenges and labor shortages. In addition, weakness in biotech and other more speculative, richly valued pockets of the market, should it continue, will make it more difficult for small cap stocks to keep up with their mostly higher quality, better resourced large cap peers. Are we good? All right, small craps and those speculative areas of the market, folks, you want to avoid. All right, we saw this chart. This is the S&P 500 above its 200-day moving average now for 413 trading days as of yesterday. It last closed below the 200-day moving average, June 2020. The 200-day moving average keeps moving up every day of every week. It now comes in at 44.25. You want to have that number handy as well, right? We talked about the December low, 45.13, the 200-day moving average, which again will change every day. It'll edge up until the S&P 500 manages to drop down to that level. Is it going to happen this year? I don't know. I don't have a crystal ball. Nobody does. We all give our opinions and our analysis, but nobody knows what's going to happen. If they did, they wouldn't be investing. They'd be buying lottery tickets and living out their days on a tropical island. All right, are we oversold, right? I mean, we were almost down to the penny, 6% from the all-time highs yesterday for the S&P 500. So we've effectively already had a 5% drawdown this early in the year, right? It took until September last year to get one. Got one early in the year here. Maybe it's a good thing we're getting all this weakness out of the way here in the early part of the year. Maybe. Anyways, we entered oversold territory yesterday. Looking here at this chart, only 25% of S&P 500 stocks were trading above their 10-day exponential moving average. That's oversold. Can it get more oversold? Absolutely, absolutely. But this is an area where you would be trying to buy dips to look for a bounce, tradable bounces. I wouldn't call it investable bounces, not based on the trend that we've seen here in the new year, which is to sell into rallies. Rallies just haven't been sustainable. So you would have wanted to buy the dip yesterday, sell the rips today. What we need to see is sustainable rallies. It's hard to do that when every single day you're seeing new lows outpace new highs. Excuse me, as I'm still trying to get over my cold. This is the NYSE new lows, Nasdaq new lows, and we're still seeing more new lows than we are new highs. The first thing, in order for the S&P 500 to trend higher, the Nasdaq, the NYSE, the Dow Jones, we gotta stop with the new lows and individual stocks within the indexes, outpacing the new highs. That's a first. Stop seeing these, robust new lows on a daily basis. It's probably because we're seeing yet another shift in risk appetite. But again, it's hard to sustain rallies when you have breadth this poor. When you do have breadth this poor, as we've had here in the new year, and really for the Nasdaq going back to probably November of last year. But what we are seeing is what is known as the Titanic syndrome, clusters of, even though we've hit new highs, we're getting pushed back, and we have a lot of stocks, a lot of securities in the indexes making 52-week lows. We haven't seen clusters like this in about 40 years. So again, you see the breadth weakness. Too many stocks are hitting 52-week lows repetitively, while last year the S&P 500 still managed to trend higher and make new highs into the very end of the year. That's what we call Titanic syndrome. And in the Nasdaq, it's been worse. And that's, why we're finally seeing a bigger correction in the Nasdaq. Nasdaq, almost to the penny, an 11% correction. As of yesterday, an 11% correction from the peak. Nasdaq's peak, Nasdaq Composite, folks, 16,121. 16,121. 11% correction as of yesterday. All right, here's your Nasdaq. Again, remember this graphic here, 450 days above the 200-day moving average. Well, we managed to close below the 200-day moving average here yesterday. That streak is over. Now it's about getting back above the 200-day moving average, folks. That would be the next bullish feat of strength. And if, looking at this chart, and it got obviously down to here, the Nasdaq Composite 6-month rate of change just went to 0. 6 months ago, we were July. In October, right where we are now, and this is the same as where we were in July. So basically, we've given back 6 months worth of gains. That's not a bubble now, is it? The Nasdaq's not in a bubble. Tech's not in a bubble. That just doesn't work that way. This is another normal, healthy, to be expected correction in the Nasdaq. Same as what we had last year, folks. In the first quarter, the Nasdaq hit the highs in February, and then produced a 12% correction. Much of what we're seeing here in the early portion of 2022 is what we saw in the early portion of 2021. The NAMO, which is the Nasdaq McClellan Oscillator, it's another way of, using the advanced decline line for the Nasdaq. That also hit oversold territory yesterday. Again, got into negative territory. We call it the NAMO. Got into negative territory yesterday. It's an oversold condition. Can it get worse? Yes, it can. Yes, it can. Yes, it can. Of course it can. But again, this is where you wanted to start buying, looking for that tradable bounce. Why do you look for that tradable bounce? If the market's going to have a down year, more than likely the stocks in your portfolio, at least some of them, are going to have a down year. Your job is just to mitigate the declines. And these oversold conditions can identify trading opportunities that will help mitigate your drawdown for the time period, whether it's a quarter or the whole of the year. And why do you want to do that? Because again, it sets you up for a more quicker return to even, if not accelerating the gains in the next year, assuming the next year is more positive with favorable returns. There's always a reason. There's always, I'm of the opinion, necessity to remain engaged as an active portfolio manager. Again, for those people, because just this week they had Richard Bernstein's technology analyst come on CNBC saying that tech's in a bubble. He expects a 50% correction in tech. I don't know how you can say it's a bubble with all the information that we have at hand. U.S. technology stock market weighting versus the economy's weighting. So as you can see, the S&P 500 technology sector, as a percent of the S&P 500 back in 2000, the dot-com period, does this look anything like that, folks? Heck, we're just trying to get back to 2012. Please stop with the hyperbole. And total S&P 500 technology sales as a percent of GDP. Again, just trying to get back to 2012. Did technology bust after 2012? No. Where's your bubble here? Right? We looked at this in the past for the Nasdaq. Everybody associates technology with the Nasdaq. We get it. Most of the Nasdaq is biotech or technology and fintech. But look at the 5-year rate of change. That is not a bubble. That's a bubble. That's not a knife. That's a knife. I remember, I forget the name of the movie with the actor. Oh man, Crocodile Dundee. Yeah, Crocodile Dundee. We talked about yields and the correlation with the Nasdaq 100 or the Nasdaq or tech with rising yields, folks. And this, dot plot basically shows you, these are the 10-year yield, monthly change down here. 0.5%, 0.6, 7, blah, blah, blah. Rising rate yields may produce minor bumps in the Nasdaq given a goodly portion of its constituency is unprofitable, but it hardly sustains a downtrend. The Nasdaq 100's 12-month return versus yield spikes, that's this chart above, the average 12-month return during yield spikes is 16.2%. The median 12-month return is 15.9 since 1990, which is basically the technology era's genesis. It really didn't start catching its legs until about 1994, 95. So there's over a longer time period, there's really no no negative consequences to yields impacting Nasdaq 100. It's just not there. This year, and this is new to me, but markets move in cycles. You may have heard of, especially if you're of a Jewish descent, Shemitah years. Market events during recent Shemitah years are noted here. It's 1966, and this year happens to be a Shemitah year. These are some of the things that we've seen during Shemitah years. Cyclical bear market, 1966. Start of basically a 2-year bear market, 1973. Of course, 1987, the stock market crash. 1994, bear market in bonds. 2001, middle year of tech bubble collapse and 9/11. 2008, of course, great financial crisis. 2015, commodity meltdown and stock market correction. I think we don't know the magnitude of what might happen here in a Shemitah year. It might just be a correction. We don't know, but this is kind of the 7-year itch, that, may need to be taken into consideration once again. It's a 7-year itch. Known as the Shemitah year is, I think in Hebrew, it's, and forgive me, sabbatical. It's a sabbatical year. But markets move in cycles, folks. All right, things have been really poor so far as investor sentiment has been concerned. The Aai Survey, which is a retail investor survey, it's a survey that looks out 6 months. So they simply ask respondents, where, do you think that stocks will be higher or lower going out 6 months? 2 weeks ago, it got down to, I think, 28%. This week, as of today, because it's released every Thursday, it got down to 21%. Folks, we haven't seen a reading this low since the 2020 pandemic crash. And there are a lot of people that think that this kind of a survey is a contrarian survey. And a lot of times it can be. It usually isn't so far as the bullish sentiment. It more often than not is when it comes to bearish sentiment. So if the bullish sentiment is very, very low, what do you think the bearish sentiment is right now? It is very, very high, folks. It's above the historical average. The bullish sentiment is below the historical average. So we got this study from Schaefer Analytics. The S&P 500 after bull bear falls below 10% or negative 10%. Historically, we'll go out 1 month over since 1987, because the survey began in 1987. They do it every single week since 1987. So 1 week return when it falls below 10%, which is where it is now. Average return, not too bad. Percent positive, coin flip, 2 weeks. Gets better so far as percent of the times it positive. Returns, 1 month later, okay. Not too bad there. Percent positivity, okay. Now, if we look at any time, just any time since 1987, any time, the average return over a week, 2 weeks, 3 weeks, look at the percent positivity rate. They're almost the same, right? So that's why I say there's not much to the study in the way of contrarian. I mean, anytime you invest in the market since 1987, the percent positivities are almost identical, right? 74 going out 6 months. There's just not an edge here. So when might there be something, to glean from the sentiment survey? So we looked further into it when the index is within 2.5% of an all-time high. And yet the reading is negative 10. The bear bull spread is negative 10. And the market is within 2.5% of an all-time high. So when it's that bearish, when sentiment is that bearish, but you're only 2.5% off of the all-time high, I think most people would think, yeah, it's time to buy. Everybody's scared. but we're within, arm's reach of an all-time high. 30 times that has happened when we've got to -10 on the bull-bear spread there. 30 times it's happened since 1987. Look at the 1-week return. It's negative, 50-50. It's still negative 2 weeks later, 50-50. 1 month later, still negative and just about 50-50. You have to go out 3 months before, if you thought the bearishness was a contrarian indicator and you should have bought, when you're this close to the all-time high. And that's the key. That's the key. We were still too close to the all-time high to use the negative sentiment in the Aai survey as a contrarian indicator, as a buy the dip indicator. Now we're further away from that all-time high now, and the sentiment has gotten worse, which just goes to prove we're a week away from the prior reading, which was 28. Now it's down to 21, and we've only drifted lower in the S&P 500. Be careful when using sentiment indicators as contrarian indicators. One of the things that people have been complaining about all last year, and they generally always do, is the fact that, the S&P 500 is so concentrated, right? Like a handful, 10 stocks make up like 25% of the S&P 500. Folks, the S&P is less concentrated today than it was back here, than it was in the 1960s. And regardless, the market is always highly concentrated. The best stocks with the best performing, metrics are going to garner investment dollars for a protracted period of time, and that's going to increase these individual stocks' market cap weighting. That's how it works. Market concentration is a feature of the market. It's not a bug of the market. That's how the market works. And this is awesome. This is from Michael Batnick of Ritz Wealth Management. This is in 1965, AT&T and General Motors represented almost 15% of the S&P 500. 7% for General Motors. AT&T was 7.5%. Two stocks, 15%. Did the market blow up, or does it still exist today? Right? So people are looking for problems that just don't exist, especially when price performance is poor and you're in a downtrend. People are looking for answers to problems that just don't exist. Market concentration is not causal of a downtrend. It's not causing market corrections. It doesn't cause crashes. It's just a feature of the market. A couple weeks ago in our weekly research report, we also talked about this is a decennial year, 2022, 1952, 62, 72, 82, 92, 2002, 2012. And this is the average performance of the S&P 500 in the decennial year. It's kind of the roadmap. Things are rocky at the start of the year, kind of settle down toward the end of the quarter, but going into the second quarter, things get rough again. In these decennial years, we had 5 of them were up, 2 of them were down. The down years were 2002, 1962. The average return, right, because this is positive, but the average return is only 3.6%. The high year return, which was 1972, was 15%. The low return, which was a decline of 23%, was in 2002. 2012 was a double-digit return year also. I think it was 12 or 13% that year. All right, we also talked about because we just had a CPI reading of 7%. And the last time we saw that was in 1982, one of these decennial years. Go figure, right? So we're seeing actually a lot of likeness to what's happening here in 2022 to some of the things that happened in 1982. And get into that. We will get into that. 1982, Ronald Reagan. It was his second year in office. 2022, it's the second year in office for President Joe Biden. And we know that second year of a presidential cycle, you tend to have, pretty good correction. Starts off okay, but pretty good correction. And the average of all second year presidential cycles is only a gain of 4.3%. When Republicans are in office or holding the executive branch, 2.9%. Democrats, 5.6%. It's the percent positivity rate is only 56%, folks. Again, it's kind of a toss-up. 1982 is in there, second year. All right, so we also know, as we kicked off this SOTM, we talked about rate hikes. Well, right now, the expectation is 4 rate hikes this year. And then you might be saying to yourself, there's no way this market can go up with 4 rate hikes. History doesn't align with that, folks. These are all the years going back to 1978 that we had at least 4 rate hikes in the calendar year. Only twice was the market down, and these declines are not significant, folks. 1.5%, 6% in 2018. Most of the time, the market is up. The average return was 8%. The median return is 9%, roughly. So, for all of the fuss about rate hikes, and don't get me wrong, this may not be the most pleasant year. There might be more volatility that actually leads to something positive towards the end of the year. You don't see 1982 on here, but bear with me. This is how 1982 started. Lo and behold, look at the decline, folks. And what's that date? 1/20/1982. As of yesterday, the S&P 500 was down 5.9% coming into today's trading session. Market was down 5.94% as of 1/20/1982. Had a very nice spike here the last trading day of January. But all rallies got sold. Rallied heavy into May. That rally got sold, found a lower low. Remember, this was also a midterm election year. It was also a decennial year. Look at this pattern, folks. Look at the lift off into the fourth quarter. Look at the pattern, lift off into the fourth quarter. Look at the decennial year. Lift off into the fourth quarter. Lift off into the fourth quarter of a midterm election year, second year of a presidential cycle. All of that in 1982, setting up exactly from what we did here. So the similarities, 1982 and 2022, and I'm not suggesting wholly at this point that this will be the analog for 2022, but man, are there a lot of similarities. Both decennial years, both year 2 of presidential cycle. Both began with a down January to this point, greater than 5% decline. Both had a bearish toy signal. This is what I was trying to avoid. So here's the toy barometer, folks. When your gain from November 19th to January 19th is less than 0, which is a negative return, right? Here's 1982. It's down 3.9% from November of 1981 to January 19th of 1982. But this particular year, the toy barometer probabilities did not play out for the year, or the next 12 months, I should say. So that would take you into January 1983, a gain of 25.3%. However, if we're just focusing on the toy barometer itself, right, things don't look right. When you have less than a 0% gain during the toy barometer period, right, and we've got 16 examples. Most recently, again, 2019, 2016, both years finished nice. So more recently, the toy barometer, if you're looking for reasons to be cautiously optimistic, we do have 6 times, 1, 2, 3, 4, 5, 6, where the toy barometer fired bearish, but yet delivered a positive return over the next 12 months. Nonetheless, the percent probability is just 38% of the time the market is positive, right? It was up 6 times, down 10 times that it fired bearish. But again, 1982 is coming up a lot. So look at the spike here, maybe something, we have this would push us into next week with the FOMC meeting, right? Everybody wants to price in the rate hikes now. And for whatever reason, usually, on FOMC day or shortly thereafter, the market actually starts to trend positively. Maybe that's what materializes here and gives us the 1982 spike into the end of the month to close out the month. And so, as I said earlier, you want to fashion, if you're thinking that this year is going to be a down year, that is no reason to walk away. It's no reason to stop being active or engaged with the market. The things that you're going to do here this year, assuming we have a mild decline for the year, which is not etched in stone, but we're just looking at probabilities. What you do this year will help you to potentially outperform the market next year. And I'll give you a perfect example of how this happened to me. In 2015, we had a nice correction, right? I know we saw this here with the Shmita. Where's my Shmita? Yeah, right, 2015. I think it was like a 16 to 18% correction in the S&P 500, which came late in the year. And I was leveraging into that with cash I had on the sidelines. It was awful, I'll be honest with you, because I was short volatility, heavy, and kept shorting into the VIX spike there. Right, that was the first rate hike in December that we had also. The Fed hiked rates for the first time in that expansion cycle in December of 2015 under Janet Yellen. And I'm leveraging into short volatility positions, UVXY. Got to a point where I had almost no cash on the sidelines, but I was convicted. I had reason to believe that my thesis would play out, even if I had to take a lesser return in the 2015 calendar year. I was positioning for the eventual reward. I didn't see us going into a recession. Credit spreads were not blowing out to an extent that warranted deleveraging and selling. The yield curve was not inverted. The outlook for earnings over the next 12 months was positive. I had low double-digit return in 2015, which still beat the market handsomely. But most of that gain happened in the first part of the year. And I saw it dwindle down as the correction ensued. But I stuck with my thesis. I looked at my process, my game plan. I extended my time horizons. And in 2016, by April, the market started to rally significantly. And I had greater than an 80% return for 2016. So yeah, maybe 2015, maybe it won't be so great. I mean, we see a lot of the quantitative data not shaping up for great probable returns this year. So far, there's still time on the clock, folks, as they say. But the things you will do this year can lead to significant outperformance in the out years. Stick with your game plan, and if the market demands it, just extend your time horizons. Don't lose your discipline, and know that things will get better on the other side of this, folks. And as I've been doing just about every week for our weekly State of the Market, is looking at what happens from November of a midterm election year to April of the following year. We have a 100% probability historically that the market was higher. Average return 17.2%. If your worst case scenario is that the market is down 17% this year, maybe your portfolio is down 25% this year, you're going to make that up really quickly. And with these probabilities, that cash on the sidelines, assuming you have it available to you here in November, if you put that to work, you're going to get back to even that much more quickly and ahead even faster. Stick with the market no matter what. Extend your time horizons. Equities are still delivering the best yield for your investment dollar. Everybody have a great week. We'll be back here next week, of course, with probably notes from the FOMC.